Here at St. Cloud State University, and also the moderator of this wonderful opportunity we have with Neel. I would like to, before we get started, thank some organizers who were instrumental not only in creating this town hall event, but also Neel had some meetings this morning with folks in the community, business leaders and others, so he could get a good sense of what's happening in St. Cloud. So I want to thank some folks straight away for their help in making that possible. King Banyan, Dean of the School of Public Affairs, and Lynn McDonald, who is a professor of economics in the School of Public Affairs at St. Cloud State. Gail Ivers, who's vice president of the St. Cloud Chamber of Commerce. Patty Gartland, who's president of the Greater St. Cloud Development Corp. Of course, Mayor Dave Kleiss here at St. Cloud, and New Flyer as well for the afternoon tour. So absolutely delighted to have this opportunity to have St. Cloud State host Neel, who, as you know, is president of the Federal Reserve Bank in Minneapolis, and to provide you all an opportunity to hear directly from Neel about economic and market issues that we are all talking about today. So I'd like to just give you a brief intro of Neel, and I won't take too long because I want to make sure we have plenty of time for you to be able to hear from Neel and be able to ask him questions. But I wanted to take some time to share his bio with you because it's quite eclectic. And I think that really is a wonderful thing, especially among Fed presidents. So Kashkari began his career as an aerospace engineer in a private company in California where he developed technology for NASA space science missions. After business graduate school, he joined Goldman Sachs in San Francisco. And his life in public service began in 2006 when he followed then Goldman Sachs CEO Henry Paulson to the US Treasury. And then in 2008, he was confirmed as Assistant Secretary of the Treasury, where he oversaw the Troubled Assets Relief Program, or TARP, which was the big bank bailout program during the financial crisis at that time. Following his tenure in Washington, Kashkari returned to California in 2009 and joined the investment management firm of PIMCO as a managing director. He left that firm in 2013 to explore returning to public service and eventually running for governor in 2014 on the Republican ticket. And my notes say here you lost.
I did.
Okay.
Thank you for that.
Yeah, that's right. But his interest in public service led to his eventual candidacy for the open president seat at the Minneapolis Fed in 2015, and he assumed the job on January 1st, 2016. So it's very interesting when I think about our talk today and did some research. I find that the Federal Reserve is something people either know a whole lot about or very little about. And it's also an interesting role, I think, and Neel will probably talk about this, because there's a group of folks that want more transparency about the inner workings of the Federal Reserve and your policy-making process. And then I've also heard others say that the Federal Reserve officials talk too much. So we're leaning on the side that he'll talk too much today, we're hoping, right? So we're looking forward to that. So I'll turn it over to Neel if you want to go ahead and make some remarks. That'd be great.
Well, first of all, thanks for having me. I really appreciate it. Thank you all for being here. It's a great turnout. Let me just spend a minute, and then we're going to do a little poll. I want to spend a minute and just tell you why I'm here. So the Federal Reserve is our nation's central bank. We were created by Congress in 1913. But something that's unique about the Federal Reserve is that Congress distributed it all around the country. So there's something called the Board of Governors in Washington, D.C. You may have heard of our current chairman of the board, Jay Powell. Before Jay Powell was Janet Yellen. Before Janet Yellen, Ben Bernanke, and then Alan Greenspan. And then they created 12 independent Federal Reserve banks, including the 9th Federal Reserve Bank, which is here, the Minneapolis Fed. So our job at the Minneapolis Fed is literally to represent this region, Minnesota, North and South Dakota, Montana, part of Michigan, and part of Wisconsin, and to learn what's happening in the local economy and bring that back to Washington, D.C. So I go back to Washington, D.C. every 6 weeks for what are called Federal Open Market Committee meetings. These are the big meetings where interest rates are set for the country. And what I do in those meetings, in part, is I talk about what's happening here in the regional economy. So my colleagues and I spend a lot of time traveling around the region, meeting with folks just like this, meeting with business leaders, meeting with workers, meeting with students, meeting with academics, to understand what's happening in the local economy. Is it growing? Are people able to find jobs? What's happening to wages? That helps make me smarter when I then make a recommendation on what should happen to interest rates for the country. So if we think the US economy is overheating, we will typically raise rates to try to cool it down by raising the cost of borrowing if you want to take out a car loan or a home loan. Or if we think the US economy is slowing, we will typically lower interest rates to stimulate economic activity and boost the economy. And that's why it's very important for me to hear directly from all of you what's happening, how are you experiencing things, what do you think about the future. So that's why I'm here, and that's why I'm grateful for you hosting us, and I'm grateful for all of you turning out. It's great to have such a packed crowd tonight. So let's try this poll, and let's see if it works. I'm told that it works, so we'll see. Well, that didn't work. Side button. Well, I've already failed. I can do next. Here. You said side button. There are a lot of side buttons on this thing. No? All right. Where's he going?
Okay, no. Why don't you give me that?
I'll give that to you. That's a good idea. Okay. How much do you know about the Federal Reserve System and the Minneapolis Fed? A, nothing. B, very little. C, some. D, a lot. So please use your phones as Ron showed you earlier. Let's see what you say. Okay. So about more than half know something about the Federal Reserve. That's pretty good. Want to go to the next question? In 1 to 2 words, how do you personally feel about the current economy? Good. Okay, so I'm seeing, obviously, good is the biggest one. Cautious, uncertain, concerned, optimistic. Recession there, that's probably going to come up today. Positive, hazy. I would say, generally speaking, people feel pretty good, but a little bit nervous about the future. So not great, but also not too bearish. That's kind of consistent with what I'm hearing, but I'm sure we're going to get into this more in our discussion today. Let's go to the next one. How would you describe the current job market and hiring demand from employers in St. Cloud? So those of you who are in the job market, how much demand is there? Okay, somewhat strong is obviously the dominant one. Neutral and very strong, and some relatively weak. I hear from a lot of employers, and I know we're going to talk about this in a little bit. I hear from a lot of employers, they say, oh my gosh, we just can't find workers. And I always push back on them, and I say, the proof is, are you paying more? And usually they say no. And I say, well, if you want more of something, you got to pay more for it. But some will say they are paying more, and so let's explore this a little bit. Usually where we're seeing the fastest wage increases are on entry-level workers, kind of first-time jobs or lower skill levels. They're having to pay up more because those folks have a lot more choices. And then as you get more senior or you get more skilled, it seems like some of the demand is tapering off. But I look forward to exploring this. Go to the next one. How would you describe recent wage growth in St. Cloud region? Again, this for me is the proof. Is this really a tight job market? You'll see it in strong wage growth. Okay, so we're clustering somewhere around neutral, don't know. Some saying somewhat strong, some saying relatively weak. So that's, that's actually consistent with what we're seeing in the data. We are seeing some job growth nationally. Wages are picking up, but they seem to be picking up moderately. They don't seem to be accelerating. So when you hear businesses say, oh my gosh, we have this historic worker shortage, the next question is, show me the money. Where's the wage growth? If there's this historic worker shortage, wages should be accelerating. They're not accelerating. What's your outlook for the St. Cloud regional economy over the next 6 months? Last question. Very optimistic, somewhat optimistic, neutral, somewhat pessimistic, very pessimistic. Okay, so this is consistent with the word cloud, where people leaned towards some optimism, but there was still a lot of uncertainty around the outlook. Great. All right. Thanks a lot, Ron, for that. Thank you all for participating. That was kind of an interesting way to just start the conversation. And so this is what I'm really interested in. How's the economy doing? How are you feeling about the economy? What are your prospects? This will help make me more informed about the economic outlook. So let me turn it over to you and we can start the Q&A.
Well, thank you. I appreciate that. So when I first arrived here a year or so ago, one of the first things I heard refers to what we were talking about, the workforce shortage. And when we go out and talk with businesses around the community, it's just the sense that we're struggling to find workers. So I want to kind of follow up on that, a piece that you were just talking about. Because in an interview you had a couple of days ago, you repeated your belief that inflation has not been rising more quickly because there are still more workers that can be enticed back to work. So, and as a part of that too, you also talked about how immigration is a key aspect to addressing the workforce shortage. So I wanted to give you an opportunity to dive in a little bit more on this topic and share with us your thoughts.
Sure. So, you know, the unemployment rate gets a lot of attention in the press. The headline unemployment rate in the country is 3.5% now, which is like a 50-year low. But that number only includes people who are actively looking for work. If you're not looking for a job, you're not counted. And when the Great Recession hit 10 years ago, it was so traumatic. A lot of people left the job market. They lost their jobs. They left the job market, couldn't find a job, then they gave up. So we kept thinking over the last few years, well, we're at full employment. Everybody who wants to work has a job. And then a miraculous thing happened. All these workers kept coming off the sidelines, taking jobs when we didn't think they were looking. I mean, literally, people answer a survey 1 month. They'll say, no, I'm not working, and I'm not looking for a job. Then the next month, they take a job. That shouldn't happen that way, right? If you said, I'm not looking for a job, how do you find a job? But it's really, really good news. And that is my explanation for why we have not seen wages pick up very much. Because as wages slowly pick up, people see that. They see their brother or their sister got a job, or their neighbor or their friend, and they say, hey, I can go get that job too. So then they go and then they get a job. So we've seen this big supply of labor, supply of workers that we didn't realize was out there, and that has helped boost the economy, and that has kept wages in check without taking off too far. So the question is, how many more are out there? So a question for St. Cloud. I know this is a very diverse population, a lot of recent immigrants to St. Cloud. A question I had for the businesses this morning, they say they can't find workers. Are they really tapping in to those immigrant communities? And I think the answer I heard was no. They are somewhat, but from some of the immigrants that I spoke to, they spoke that a lot of folks in their communities don't have jobs and would like to work. So the question is, what are the barriers that are keeping those employers who say they want to find workers from hiring those folks who want to find jobs? And if we can build those bridges, it'll be a win-win for everyone.
So do you have any examples across the country, because St. Cloud certainly is not unique in this issue, any strategies or approaches that you particularly, the data would suggest is helpful in helping kind of bridge this gap?
Well, the best thing that I've observed, and this is, again, it's almost a miraculous, maybe that's too strong a word, but it's a wonderful development. As the economy has gotten stronger and the job market has gotten tighter, businesses are now going to extraordinary lengths that they didn't used to do because it's in their own interest to do it. So you're seeing businesses that will say, you know what, I used to want a machinist that had this certain set of skills. I can't find that, so I'll train you. They didn't used to train people, but I'll train you on how to use this machine. Or they'll look at people who say, I used to demand a 4-year degree. You know, I don't need a 4-year degree, actually. If you have a 2-year degree, I'll give you a chance. So they're lowering some of the qualifications that are necessary. Or they're saying, I don't need to do a drug test for this certain job. Or I don't need to do a background check for this other job. Or we'll bus people to our factory. If you don't have transportation, we'll arrange a bus from your town to this thing. So you're seeing businesses all across the country do extraordinary things because they need to, because it's in their own economic interest to do it. And I think that's great news, because if they're investing to train workers and to give people the chance, it's good for the worker and it ends up being good for the business.
That's right. So Neel, earlier you mentioned the Great Recession as part of that. The Minneapolis Fed and you specifically have been an outspoken critic on the too big to fail piece. The concept that certain banks are too big for the federal government to allow to fail in a crisis. given the domino effect it would have on the broader economy. Now, we thought that, Dodd-Frank was supposed to address this issue, and I wonder if you could speak a little bit about that and what can and should be done.
Sure. So I was, during the financial crisis, I led the program that bailed out the biggest banks. We hated that we had to do it. We were a free market Republican administration, and our view was if big banks made a mistake, they should bear the consequences of those mistakes. But if we had allowed the biggest banks in America to all collapse, they would have brought down the financial system and the economy with it, and it would have been all of us suffering as a result of it. So the decision was made, Congress authorized big bailout to stabilize the big banks. Well, we never, ever, ever want to have to do that again. And the best way to prevent that from happening again is to make sure that the big banks have enough of their own money, their own capital, ready to take the losses if they make mistakes. When my wife and I moved to Minnesota, we took out a loan to buy a house. Our bank made us put 20% down on our mortgage. That down payment, you know why you have a down payment? It's there to protect the bank in case you can't pay back your loan. And if you put down 50%, then the bank is totally protected. If you put down 20%, they're pretty protected. If you only put down 5 or 10%, then it's riskier for the bank. So the more money you put down, the safer the loan. Well, banks made me put down 20%. They only put down about half of that on their own investments. So literally, if we make banks put down more money of their own money, their shareholders' money, we could protect taxpayers from future bailouts in case banks run into trouble. That's the answer. Now, the big banks hate it. They hate it when I talk about this because it directly affects their share price. So my view is I want a free market system where people take the risks and reward of their own investments, but that means banks should have their own money on the line, not taxpayers' money on the line.
As a follow-up to that, that was quite a time, wasn't it, for the economy? And I wonder what's the one thing that has changed as a result of the Great Recession that you think about in your role as Fed president?
It's hard to pick one thing. I think, going back to the labor market, the Great Recession was so devastating for so many families. It has taken us 10 years to get the labor market back to where it was in 2007. It's taken 10 years to get back there. That's a real cost to millions of people across the country. So we need to avoid those very, recessions are going to happen. We know in economic cycles, but there are kind of normal recessions, which there's a quick recovery. There's not that much damage that's done. And then there are these very rare, 50-year events, 180-year events that are devastating for society. We really need to protect against these devastating events because the costs are profound.
Thank you for that. I think we now have the opportunity to get some questions from the audience and begin our conversation. So let's go ahead and go.
And we've got mics in the back. Yep. Hi there.
Yes.
Could you tell me your name, please, when you ask the question?
Yes, for sure. Monica Garcia Perez from the Economics Department. And I have a question, kind of, even if when you answer the question, kind of explain what I'm asking to most likely students that are here. The case of the inverted yield curve and the expectation about possibility of future recession and how that can impact the local economy. And by local, I'm not thinking about the regional, I'm thinking about the central Minnesota and this area.
Sure.
Thank you.
So people ask us, are we going to have a recession? And I'll tell you, forecasting a recession is incredibly difficult. If any of us were any good at it, we would be able to take action to try to prevent the recession. And the fact is, recessions happen. That means we're all lousy at predicting recessions. The single best indicator we do have of recessions is this thing called the inverted yield curve. So what is the yield curve? When the government borrows money to fund itself, it borrows money from all of you, you and me. If you buy a treasury bond, you are making a loan to the US government. So if you buy a 1-year bond, you're making a 1-year loan to the government. If you buy a 30-year bond, you're tying up your money for 30 years and you're making a 30-year loan to the government. Typically, if you tie up your money for longer, you want a higher interest rate because they're borrowing your money for a long period of time than if you just tie it up for a year or two. So if you plot that, if you plot those interest rates, they form an upward sloping curve with short-term bonds having a low interest rate, longer-term bonds having a longer interest rate. Well, once in a while, something goofy happens and it flips. That short-term interest rates are higher than long-term interest rates. That's what's called the yield curve has inverted. And why does that happen? It happens because investors are worried about the future. They're worried about, is there a recession coming? They're worried, they say, I'd rather tie up my money for longer, even if I get a lower interest rate, because it's safer than if I put it in the stock market. So it's a sign of nervousness from investors. So every time that has happened in the past 40 or 50 years, a recession is followed in the next year or two. That has now happened. So that's a concerning sign. Now, every time it happens, there are some economists who go around and say, don't worry about it, this time is different. And then a year or two later, a recession happens, and they say, whoops, we were wrong, this time is not different. So right now, there are some economists going around saying, don't worry about it, this time is different. Unfortunately, I don't know if this time is different. I take the signal seriously. The good news is the US consumers are still doing well. By and large, most people have jobs. As I said, their wages are slowly climbing. So people have money to spend on their families, and they're spending it. But that's a little bit of a backward-looking indicator. A forward-looking indicator is that businesses are reducing their investments because businesses seem to be nervous about the future. So right now, the signals are mixed. And if we were to have a recession in the economy, in the US economy, it would affect St. Cloud. It would affect central Minnesota. And you might see unemployment rates climb here as businesses are forced to cut back. And so unfortunately, when recessions happen, it's very hard to be immune from that. That's why we want to avoid them. Gentleman over here.
Hello, my name is Bill Ham, and you brought up housing in a roundabout fashion, talking about your home loan. Now, we've got a lot of people who are non-white in this crowd. We're in the second most racist state in the nation. We have serious debt loads associated with student loans, associated with medical bills. We have a horrendous wealth gap here in Minnesota. It's a very big part of that racist issue we have in Minnesota. How would you suggest we deal with this problem?
Well, I'll say a couple things. One is, I don't know how to address racism at its core. Right? There's been racism in this country for hundreds of years. I will say this, my parents are immigrants from India. My wife is an immigrant from the Philippines. I think we have a lot of imperfections as a society, but I also think we do a lot of things well, and I think we do a lot of things better than other countries do. And I actually think we're a more welcoming society than any other country in the world. And so for me, I think we should find our successes and celebrate those and keep taking those forward and do better. And I think we can do better. In terms of the gaps, we actually launched at the Minneapolis Fed a research center focused on analyzing these gaps, analyzing why they're there, why they're so persistent, and what we can do to close those gaps. I'll tell you one thing, we're at a university, one thing is focusing on making sure every kid in Minnesota gets a good education. We're not going to close wealth gaps if we don't empower all of our young people with the skills to participate in the economy and to succeed. So you asked a very big question, you asked an important question. Hard for me to answer it in this short period of time, but for me, I would start with education and make sure every Minnesota kid gets a good education. Someone over here has the mic. Oh.
Mr. Kashkari, I'd first just like to say thank you so much for coming here on behalf of myself and the rest of the Econ Association that I'm a part of. I'm one of the 4 board members on the Econ Association here in St. Cloud State. And in fact, at our last meeting, we looked at a really compelling article that described the Minnesota economy specifically, saying that its real economy grew by 2.6% in the first quarter of 2019, which was below the national average of 3.1% throughout the first quarter of 2019. And from September of last year to the August of this year, unemployment rose by 20.1% in this state alone. Now, what we decided as the association was that we were thinking that it was more toward agriculture, and which is one of our biggest, employers here in the state of Minnesota. And we were just curious what the Fed would be doing to incentivize either alternative job growth in agriculture, or rather, what is incentivizing people to get into the agriculture market here in Minnesota in order to kind of pad that 20%?
Well, thanks for your question, and thanks for having me. I've seen the numbers that say Minnesota's unemployment rate has ticked up. I'm a little skeptical. I think the data tends to be pretty noisy month to month, quarter to quarter. The state data is noisier than the federal data. When I travel around the region, I am hearing businesses saying they're a little bit nervous about the future. I haven't met anybody laying people off. I mean, there are anecdotes. Electrolux is shutting a plant, et cetera, here in St. Cloud. Those things seem to happen on an ongoing basis as businesses are, adjusting to market dynamics. But I've not seen any evidence that, as a whole, Minnesota businesses are now cutting workers. Again, most of the commentary is we can't find workers. We need to hire more people. So I'm a little bit skeptical that the unemployment has really gone up in Minnesota. And it may also be more people coming in looking for jobs. Again, the unemployment rate can go up if people get laid off, or if a lot more people say, hey, I want to get a job. That's another way the unemployment rate can go up. So we need to be a little bit careful on that. In terms of ag, the ag sector has been under pressure in this region for a number of years, in part by just low commodity prices, in part because they're very productive and they've had very high production levels, which has led to a lot of supply, which has led prices down. Now it's made harder by tariffs and trade wars and China not buying soybeans, et cetera. So I think that these issues are very complex. At the Minneapolis Fed and the Federal Reserve, we can't target any one sector. Our primary policy tool is moving interest rates up and down, but we have to do that for the whole country. We can't target it just to the ag sector. So we have to make our best recommendations for what's right for the U.S. economy as a whole, recognizing that some sectors may be doing better than others at any given time.
Well, given that we're in central Minnesota, I wanted to sort of follow up on that in terms of the economic effects of the various tariffs and trades, and maybe you're thinking about the future and where we might be headed. Well,
this is something that's very hard for us because we have a lot of very sophisticated economic models, and we've got researchers at the Minneapolis Fed, researchers all around the country, hundreds of them in Washington, D.C., that run simulations of what's going to happen to the U.S. economy if different things happen. Like if the price of oil went up to $100 a barrel, we can estimate how does that flow through to the U.S. economy. Trade war is almost impossible to measure because we can factor in if the prices of goods go up that we buy from China, we can model that and how that flows through the U.S. economy. But there's another channel, there's another avenue that it affects psychology. And if everybody gets concerned about the trade war and businesses all get nervous about what the future holds, they might just pull back and say, you know what, I'm going to pause. I'm not going to make this investment. I'm not going to hire these extra workers. Well, if most businesses do that at the same time, that becomes a self-fulfilling prophecy, and that itself can lead us to a recession. So was that the trade war that caused the recession, or the trade war scared people and the scare caused the recession? It's very hard for us to estimate it. So we're trying our best to model this all out, but it's very hard to know. And when you layer on the politics, domestic American politics, Chinese politics, and how they intersect with each other, it's almost that your guess is as good as mine is where this goes.
Thank you.
Hi, my name is Nadine and I work in the finance industry. One of the things that we're always looking at is obviously globally from interest rates, commodities, all those types of things. And we're seeing in the European countries negative interest rates on deposits. How do you see that long-term impacting and coming over to the United States and what that might look like if and when that does occur? Because it's real over in Europe right now.
Sure. So one of the big challenges that central banks in advanced economies are facing is this very low interest rate environment and low inflation environment. So let me just back up for a second. There's a really important concept called the neutral interest rate. What interest rate neither stimulates the economy nor restrains the economy? Well, that interest rate has been gradually declining over the past 40 years, and we don't set it. That interest rate is set by how much people save. It's set by demographics. So as societies are aging, people tend to save more and spend less. So there's more savings in the world economy. It's set by technology development and what's happening in investment. And it's ultimately a balance of savings and investment. So we at the Fed and the European Central Bank and the Bank of Japan, we don't set the neutral interest rate. So think of it this way. The neutral interest rate's been declining over 40 years. We move interest rates up and down around that trend to try to manage economic cycles, but we don't set that trend. So here we are in a very low interest rate environment. In Europe and Japan, they've gone negative interest rates. Is that going to happen here? I don't think so. We certainly don't want it to happen here, but I also can't rule it out because we are the recipients of where that neutral is. We're not deciding where that neutral is. We know demographics is part of this. We know that Europe's demographics are worse than America's. We know Japan's demographics are far worse than America's. So I think that would suggest we're somewhat better off. We also, as imperfect as we are in immigration and integrating immigrants, we're imperfect. In my opinion, we're better than anybody else in the world. And that is a tool, a key tool of economic growth for us if we want to continue to use it, and I hope we do. So there are a lot of factors out there that mean that America could be different than Europe and Japan, but we also can't rule out that we could get dragged there over time. Now we're on the mic's going to come to you. We're on the live stream, or I can repeat your question. Why don't you do that? Say it to me and I'll repeat your question.
With the Fed's other policy opportunity is to increase or decrease the balance sheet.
Yep.
Why are they decreasing the balance sheet and effectively putting more competition for longer term rates when we have the spread and yield?
So the gentleman asked about the Fed's other, our primary policy tool is moving interest rates up and down. A secondary policy tool is the Fed's balance sheet where we buy long-term bonds to try to drive down long-term interest rates. And he asked, why is the Fed shrinking its balance sheet now when, and that could be leading to, say the last part.
They backed off shrinking it.
Yeah.
And is that creating, less demand for securities?
We've backed off shrinking it, so is that creating less? We backed off shrinking it, which is true. We stopped. So is that creating less? Why is that creating less demand for security?
More demand. And if they continue to shrink it, there would be more demand. Interest rates should go up, arguably, wouldn't they?
If we continue to shrink it, there'd be more supply.
Yeah.
So interest rates would go up. It's a very complicated issue. Part of the reason our balance sheet is sized the way it is not only what we're trying to do in terms of monetary policy, but also in terms of providing reserves into the financial system. So this is a very technical issue. About 3 or 4 weeks ago, we saw a spike in short-term interest rates in the money markets. And one of the interpretations of that is some people have argued that the Fed shrunk their balance sheet too far and drained too many reserves out of the interest rate market or the federal funds market, so to speak. And so now I think the chairman today said that we would expect to announce something in the future about potentially providing more reserves into the system. So our balance sheet is sized in part because of how we want to set monetary policy, but part of our balance sheet is sized just on making sure the financial system runs smoothly. And so if we start to expand our balance sheet again, it's going to be to make sure that the financial system is running smoothly, not necessarily a change in monetary policy. Sorry, it's a very technical question you asked. It has multiple elements to the answer. Who's got the mic? Oh, this gentleman.
Hello, my name is Jeremy. I'm a senior here at St. Cloud State University and president of D Corp Student Organization. D Corp Student Organization is doing one of the largest studies on Minnesota, and 1/12 of that is we're creating Minnesota Peace Pillars. And we're making the argument that having a sound business environment brings peace to those communities. The questions that were on the screen were all qualitative, and then you've also made statements about quantitative, such as GDP per capita, interest rates, bonds. But can you provide 3 quantitative indicators that would indicate a good business environment or a sound economy?
Sure. 3 quantitative ones would be some of the ones we talked about. I mean, I do think a low unemployment rate is one indicator. It's not a perfect measure of health in the labor market, but it's one indicator. I think the annual wage growth is another important indicator. So right now, it's around 2.9% nationally, maybe somewhat lower than that. It has fallen a little bit from its peak earlier this year. But it's not signaling a very high wage growth. And then GDP growth. Is the economy growing overall? And how fast is the economy growing? Again, our population is growing more slowly, so our economy is going to grow more slowly, all else being equal. And what is so we think the potential growth rate of the economy is lower than it was 20 or 30 years ago, simply because our population is growing more slowly. That's another important measure.
First, I've got to make an observation that I think the Federal Reserve in the U.S., along with Treasury, did a much better job through the bond buying program and recapitalizing banks than Europe and their economies. have not recovered as much? Is it because of not recapitalizing the bank, or what other factors may be involved?
I think that's part of it. I think that the Washington, the Fed, Treasury, Congress were more aggressive in dealing with our financial crisis quickly and getting the banks to a place where they could start lending again to support the economy. I think that that's absolutely true, and not to mention the fiscal stimulus that was passed as part of that. I also think our economy is more flexible and more dynamic just in good times than Europe is, than Japan is, and we adjust more quickly. You know, the biggest, it's funny, if you think about most countries would love to have one big innovative company, an Amazon or a Google or a Microsoft or a Facebook. We have dozens of them. And just the innovation of the US economy is extraordinary. And each one of those companies would be a national champion in any other country. And we have so many of them. That just, to me, that just speaks to the dynamism of the US economy, our education system, our legal system, et cetera. So that's why I think we're as strong as we are.
I'm more just a photographer here, but piqued my interest.
Where are you?
I'm right over here.
Okay,
Sorry.
thank you.
Thank you for coming. So it may be just more of your opinion, but with a possible looming recession, and if that grows past the U.S. banks and affects the central banks of the world, what role would the IMF and possibly cryptocurrency play in resolving possible bailouts for central banks, or kind of saving the day?
Yeah, I think cryptocurrency is a farce. The cryptocurrency has no role to play in helping central banks. I mean, let me ask you this. Has anybody in this room bought something with Bitcoin? A pack of gum. What have you bought? No, he traded it. He didn't buy anything. No, that's not what I'm looking for. Has anybody actually bought a physical good using Bitcoin? What have you bought?
I bought a book.
You bought a book. And tell me, how did you do that?
I went through like certain websites. They didn't collect. They would either be PayPal or Bitcoin.
Yeah.
And they didn't allow like different currency exchanges because of fraud. So we just had to use Bitcoin. I wanted to see if it worked.
Did it work?
Yeah.
And was it expensive? Like, was there high transaction costs?
I bought it when Bitcoin was lower, so it was fine.
It was okay. All right. So I appreciate it. This is the first time I've ever met somebody who's actually bought something, other than trading it, who's actually bought something with Bitcoin. So here's the problem with all of these cryptocurrencies and why I consider them to be a farce. There's no barrier to entry to you creating a new cryptocurrency. So you can't go create a US dollar. The US government has a monopoly on creating dollars. If you try to create your own dollars, the Secret Service will knock on your door and arrest you. Literally. That's what the Secret Service is they protect the president as their second job. Their primary job was going after counterfeiters. But there's no barrier to entry to you creating your own cryptocurrency. So there are thousands of these garbage coins that have been created, and people have been fleeced by tens of billions of dollars investing in this garbage. And so until somebody can come up to some barrier that actually means, no, this is the one, this is the cryptocurrency that really counts, it's just the wild, wild west where people are getting fleeced. So, sorry, that was a fun part of your question. But I'm confident that advanced economy central banks are resilient, have the resources they need, have the tools that they need to deal with the economy that we see in the next 10 years. But thanks for asking the question.
Thank you for coming. I was curious about the money supply, and do you, at the FOMC meetings, do you look at like Divizia money supply, shadow stats, where they publish M3 and the different monetary indicators?
You know, we do, but not very much. We much more pay attention to interest rates, the federal funds rate, what's happening to inflation, inflation expectations, just because the definition of money has now become, as there has been innovation, what counts in M1, M2, M3, it's evolved over time. And so we found it's much easier and much more reliable just to look at what's actually happening to inflation, what's actually happening to inflation expectations, what's happening to interest rates, the federal funds rate, to try to get a sense of the current stance of monetary policy. And then I look at things like, we talked about the yield curve. I look at the yield curve as one indicator of, is monetary policy expansionary or contractionary? Because to me, the long end of the interest rate curve, like say the 10-year Treasury, gives me feedback on where neutral is. So is it literally an indicator of a recession? I'm not sure. but is it an indicator that monetary policy might be tight, might be tighter than we realize? That does give me that information.
Where do you think neutral is at, %?
I think in terms of where is neutral today, I think we're probably a little bit close to neutral today. Be my best guess on where neutral is. I mean, the yield curve is basically, the 2-10 yield curve is basically flat today. So 2-year versus 10-year bonds, basically flat today. So I think we're probably pretty close to neutral today. We could be slightly contractionary, but I don't think we should be contractionary. I think we should be somewhat accommodative. That's why I'm generally in favor of somewhat lower interest rates, though I don't know how much lower we need to go. I think we're going to keep going all day. Go ahead.
You'd support like 25 basis points, but
I think given what I know now about the economy, yes, but I want to see the data come in before I make any final recommendations. So we just made news. That's the news that we're going to make tonight. I usually do these town halls, and one of my goals is no headlines.
And there's one.
There's one
there. That's
so,
right. Well,
thank you.
Speaking of news, while we're working for another question, we always hear about the Fed when it comes time about what you're going to do about the interest rates. So I have a two-part question for you. You've talked about the interest rate being a key factor and lever in what you do. And I wanted to give you an opportunity to really explain, since 40% of the audience knows somewhat, right, about the Fed and what it does, if you could give us a synopsis, really, of your thinking of the interest rates and the economy. And then the second part of the question is navigating the political aspect around that, because there's a lot of politics around and some pressure that's new, maybe new,
Sure.
coming to bear. So could you speak to that?
Tell me the first one again.
Well, the first one is really about the interest rates,
Yeah.
and kind of your synopsis about the interest rates and the economy, and just explain a little bit to the audience
Sure.
about that dynamic.
So we talk a lot about something called our dual mandate. So when Congress created us, Congress also has given us two goals that we strive to achieve in the economy. One goal is maximum employment. As many people as possible have jobs who want to work. And then the other goal are stable prices. Think of an economy that's not overheating, but also not crawling. And typically we think these two things are linked like a seesaw. So as the economy heats up, businesses have to compete to find workers. We achieve maximum employment. Businesses have to pay up, and then that leads to inflation. So as the economy gets tighter, you can see more inflation, and it's like a seesaw. We're trying to balance these two things. And so if the economy is getting hot and wages are taking off and inflation is climbing, we'll raise interest rates to try to cool things down, which can then lead to higher unemployment potentially, and people will lose their jobs. So we're trying to balance these two goals, which sometimes can be divergent. And that's effectively what we're trying to do. The last few years, in my opinion, there really hasn't been a trade-off, because we've had slack in the labor market, more workers wanted to work, and their inflation was still low, so we didn't have to make any costly trade-offs there. Okay. Then the second one was on the politics.
Yes, sir, yes. Right.
So, one thing that we all pride ourselves in the Federal Reserve is doing our very best to make decisions based on data and analysis, not based on politics. One thing that we've learned around the world is when central banks play politics, they make bad decisions for the country, and then it ends up leading to bad economic outcomes for all of us. So governments around the world, advanced economy governments, and including in America, have basically said, let's keep the Federal Reserve and the central banks removed from politics. They'll leave us alone, and we should leave them alone. Let's just focus on our day jobs. And I got to tell you, honestly, I've now been at the Fed for almost 4 years. I'm really proud of the institution, how everyone that I work with, senior to junior level, works really hard to say, let's focus on data and analysis. Let's leave the politics aside. And the louder the political heat gets turned up, the more we all run to data. And it's just like, let's go hug the data. This is our true north. And we're going to tie ourselves to data. So the heat can get turned up as loud as you want. We're going to stick to data. And I think that that's working very well. And I give our current chairman and our prior chair, Janet Yellen and now Jay Powell, great credit, because they are continuing to lead us down this path. And we all support them in that. And that's the right thing to do for the country.
Hi, I'm Jake Bowerly, Benton County Commissioner and proud St. Cloud State graduate, School of Business and Economics. So my stepson also works at the Federal Reserve in Boston. We have pretty good discussions and robust dialogue. But my question is, what's the black swan ahead? What keeps you up at night?
Boy, that's a good question. The thing is, the black swan is the thing you never see, right? So When I first went to Treasury in 2006, I went before the financial crisis, my boss, Treasury Secretary Paulson, said, it's been 10 years, we're due for some kind of a crisis. So a group of us from Treasury and the Federal Reserve and the SEC went around trying to look at what could be the black swan that's going to hit us. We looked at a lot of different scenarios. None of us looked at a housing market national correction. So we were looking and we missed it. Now it seems obvious, but it didn't seem obvious at the time. One question a lot of people have is we're in this low rate environment, and is it leading investors to take risks that they don't understand to try to generate returns? The answer is we don't know, because it's very hard to tell. They call that reaching for yield behavior. Is it reaching for yield, or is it repricing a lower interest rate environment? So if investors around the world figure out that we are in a low interest rate environment, that the neutral rate is low, if you take the same cash flows and you discount them at a lower interest rate, you're going to end up with a higher valuation. So is it reaching for yield, or is it repricing a lower interest rate environment? I don't know. So if it is in fact reaching for yield, and I think if it is reaching for yield, then that could be a risk that could be brewing. If it is simply repricing a lower neutral interest rate environment, then it shouldn't be riskier. So that's one big question that I think we're all wrestling with. Hi.
Hi. Okay. All right, so you talked about how like wages aren't going up even though there's more people, or there's more jobs and people to fill them. My dad's an economic developer for West St. Paul, and he says that there shouldn't be a minimum wage higher than $10 an hour because wages will just gradually increase. So what's kind of your opinion about the minimum wage being a federal $15 an hour? And do you think that'll help or hurt the economy?
Sure. So let me first say that Minneapolis and St. Paul have both enacted minimum wage increases up to $15 an hour over a number of years, and they both selected the Minneapolis Fed to do a long-term research study to study the economic effects of this. So this is going to be years of analysis before we know for sure. One view is that you raise the minimum wage and it hurts people because people lose their jobs. Or what some businesses do is they cut back your hours. So even if you keep your job, but you have fewer hours, you may not be taking home any more money. So that's the negative view. The positive view is, well, people who have higher wages get a raise. So the data right now, the analysis, the research is mixed on that view. I would say, just my own opinion, raising the minimum wage when unemployment is low is going to be less costly than raising the minimum wage when unemployment is high. So this would seem to be a good time to do it because generally businesses say they need to find workers and they can't find workers. In terms of $15 an hour nationally, I guess my own personal view is there's a lot of heterogeneity around the country. You know, St. Cloud is different from San Francisco, is different from Houston, is different from Atlanta. My gut tells me it's probably better for cities or states to make these decisions that's right for their local economy than for one size fits all for the country. But that's more of a political calculus. Personally, I think if you did it more locally or regionally, you'd have fewer of these trade-offs than if you do one size fits all for the whole country. But I understand that people may have a different view. Thanks for that question. Hi.
Thanks for. Oh,
sorry.
I've been waiting a long time to ask you this afternoon here. I'm Sarah. I am one of many community bankers here in the room. If anybody knows me, I'm very much a balance sheet lender, but my throat went up to here when you talked about a 20% capital ratio. I was hoping you could provide a little bit more clarity around that and also share any, salient facts you have on why Dodd-Frank did not solve some of the underlying concerns in the banking industry.
But so thanks for your question, but hold the mic, please. Because most community banks have much higher capital ratios than the big banks. And that's the opposite of the way it should be, right? The community banks are not risky. I mean, I hope your bank is well run. I hope it's safe and sound. I'm sure it is.
Absolutely.
Okay, but if it weren't, your bank is not going to bring down the U.S. economy. Mm-hmm. So that's why, in my view, the biggest banks in America should have higher capital ratios than the small banks. But most small banks have much higher capital ratios than the big banks. So it's literally the opposite of the way that it should be.
So you would propose different capital ratios based on asset size?
Absolutely. So what I described, in fact, we published a Minneapolis Fed's plan on too big to fail It's for banks of $250 billion and above are these very high capital ratios, because those are the ones that are risky for the U.S. economy if they were to come down. What was the second part of your question?
Dodd-Frank, in a nutshell, why do you think it didn't solve the issues?
It did some good. Banks have higher capital than they had before. They've got better liquidity than they had before. I think my mic is cutting out now. Or I'm just losing, there we go. So it did do some good, but it did not go far enough. And one concern is it seemed to have saddled a lot of smaller banks with very burdensome regulations. Again, your bank, I don't know your bank, but your bank is not going to bring down the U.S. economy. So your bank should not be subject to the same risks or the same controls that the biggest banks have. And it's much easier for them to afford these compliance requirements than it is for a small bank. So I don't think Dodd-Frank did a good enough job tailoring regulations for where the risks lie.
Okay, thank you.
Thank you.
I think it's my turn now. I'm Luke Greiner. I'm a labor market analyst with the state, with DEED, the Labor Market Information Office. But so I study the labor market for my day job, but I'm really a little bit curious where the Fed and the FOMC sees themselves positioned if we are to run into another recession. What type of tools are in the toolbox if we're already clawing back our reserve rate?
Yep, thanks for your question. So typically when there's a recession, the Federal Reserve would cut interest rates excuse me, by 4 or 5 percentage points. And given that rates are much lower than that today, less than 2%, we would have less room to cut rates if a recession were to hit. That's where we would turn to some of these other tools that somebody earlier asked me about, which is expanding our balance sheet. So what do? When we move interest rates up and down, we're moving an overnight rate up and down that banks charge each other. But you and I don't care about overnight rates. If you buy a house, you care about an interest rate for the next 10 years or the next 20 years. But by moving overnight rates up and down, we do have some influence on long-term rates, and that's really what stimulates economic activity. So once the Federal Reserve cut to zero in the Great Recession, then they started buying up long-term bonds to try to drive down long-term interest rates directly. People were afraid of that. They thought that could lead to runaway inflation or that could devalue the dollar. Well, none of those risks came true. So I think we are more confident in how we could use quantitative easing in a future downturn if we needed to use it. So in my view, the first thing we would do if there was a recession, cut the short-term interest rate down to zero or near zero. And then if we needed to, we could turn to the balance sheet to use quantitative easing again to try to provide more stimulus to the economy.
Do the other presidents have the same view of acceptance for QE?
I think generally speaking, the Federal Open Market Committee accepts that quantitative easing is a tool that we have in our toolkit. I'm sure there will be a debate about when to use it, how much to use it, et cetera. But I think generally speaking, there's wide acceptance that it is now a tool in the toolkit if we need to use it. I hope I didn't get into trouble for saying that. I don't think so.
Hi. Recently, I saw in Colorado that they had taken $10 million from marijuana dispensaries and put it into the education system. I'm wondering what would happen if you did that on a national level, if that would help things or hurt things more.
You know, call me a skeptic. I mean, the idea, I don't see this as a real source of economic competitiveness, right? It's like saying, well, how do we get people to drink more? Get people to drink more, we're really going to be a boost to our economy. I'm not making a value judgment between marijuana and alcohol, and I drink. So this isn't some moral judgment I'm offering. I'm just saying, does this improve U.S. economic competitiveness? I don't see it. It's like, so I think there are better ways for us to grow our economy. Do I think investing in education is a good thing? Absolutely. I'm just skeptical that marijuana is all of a sudden going to be some growth driver of U.S. economic competitiveness. I don't think having a bunch of people high is going to make us more competitive economically.
You know I spent some time in Colorado, right?
Yes, actually, what do you think?
No, I'm just... Next question. That's right, next, yes, sir.
Yes, I was wondering, does the Fed look at the effect of market power on inflation, wages, interest rates, and wealth disparity?
Does the Fed look at market power on the effect on inflation, interest rates, wealth disparity, et cetera? We do. One of the things we're trying to understand is why is inflation low? Why are wages not growing more quickly? One big thing we look at, So the U.S. economy, every economy generates so much income. So the U.S. economy generates a pie of income that's really big every year. And then that pie gets sliced up, and some chunk of it goes to labor, goes to workers, and the remaining goes to capital, or the owners of companies. Over time, over the last 30 or 40 years, labor's share of income has gradually been declining. And people are asking, why is that? Why is less of the share of income going to workers relative to businesses or relative to capital? One theory is that unions have lost power over the last 20 or 30 years, so they have a less strong ability to negotiate for higher wages or a bigger share. Another theory is that big firms have more market power and can control the market, either the labor market or the markets that they're in, and there's more concentration. I think this is a topic of keen interest to folks at the Federal Reserve because it does have implications for, is the U.S. economy overheating? What's the outlook for inflation? But I'll tell you, I have not seen, I don't know that we know the answer yet, but it is something a lot of researchers are looking at and paying attention to.
I think we have time for one more question.
Who's got the mic?
Wealth advisor.
Can you go closer to the mic?
There. Craig Pop, wealth advisor and St. Cloud State alum. The repo markets, you made comment about the spike in the overnight rate a little bit earlier, and it was sort of passed off as something temporary and short term. However, we've seen sort of an extension of the facility, and I think you've announced it into like November now. Is there a concern, or should we be concerned with some liquidity in the system?
Well, so let me say there's a difference between what monetary policy we choose to have for the country. Do we want to stimulate or restrain the economy? And then how do we transmit that monetary policy into the economy? This is about the transmission. It's not about the stance of policy. And so the Federal Reserve and the New York Fed took appropriate action when interest rates were not transmitting our policy decision effectively to make sure there was enough liquidity so the transmission was there. And again, just before I came in here, I saw that Chairman Powell made some comments today that we'll be announcing other actions to make sure that the transmission is effective. And so this is nothing to be alarmed about. This is simply about making sure the financial system plumbing is working effectively. And I'm very confident that the Federal Reserve has the ability to transmit monetary policy into the economy appropriately. So I don't think it's a big deal.
Are you going to let the balance sheet grow a little bit?
Stay tuned. Stay tuned.
That's right. Well, Neel, thank you. I have just one question for you, if you could close on
Sure.
this. We have a lot of students here today and listening. And I guess what strikes me is your education journey is I imagine you didn't start out by saying, I'm going to be the president of the Federal Reserve. But could you talk a little bit and reflect on how important your education was in terms of foundational to your career and the different ways you moved in and out of all the things that you've done over your life?
Sure. Education's been everything. I mean, I literally think this is the greatest country in the world. You need to get a good education. If you get a good education, every door can be open to you, and I'm proof of that. My parents were immigrants from India. We were not wealthy. We were not powerful. We were not connected. I got a good education, and that opened all the doors for me. And then my career path has been meandering. I started out, I did a bachelor's and master's degree in mechanical engineering. Funny thing is in policy making, I use my engineering all the time. It's not literally the thermodynamics or the fluid dynamics, but it's the problem-solving skills I learned as an engineer are completely applicable in other stages of my career, and certainly at the Federal Reserve. And so, if I can offer advice to students is, keep pursuing your education, keep learning, pursue things that you're really interested in. If you're really interested in something, you're more likely to do well at it because you're going to love what you're doing and you're going to apply yourself fully. And if you do well at what you're doing, it's going to open more doors and you're going to be more successful. So my career has not been any plan. I've pursued things that I found interesting and challenging that led me to do well at them, that opened doors. And then I saw, wow, this is neat over here. Let me go do that. Let me go try that. And so your life can be long and you can do lots of different things. But for me, I'm a deep, deep believer in education is the key to all of this.
Great. What a great way to end. Let's thank Neel here for being here.
Thank you for having me. Really appreciate it.
Thank you.
Thank you. This is great. Really fun.